One of the key factors that influences natural gas prices is the level of storage in the U.S. Storage is used to balance the supply and demand of natural gas throughout the year. When storage is low, prices tend to rise as there is less cushion to meet unexpected spikes in demand or drops in production. When storage is high, prices tend to fall as there is more surplus to absorb any shocks in the market. According to the latest data from the Energy Information Administration, EIA, the U.S. natural gas storage level as of May 12, 2023 was 2,548 billion cubic feet, BCF. This is 509 billion cubic feet higher than last year at this time and 332 billion cubic feet above the 5-year average. This means that the U.S. has more natural gas in storage than usual for this time of the year, which puts downward pressure on prices. However, this does not mean that natural gas prices will stay low forever. There are several factors that could cause storage levels to decline rapidly and prices to explode in the near future. These include the increasing demand for natural gas from power generation, industrial use, and exports. As the U.S. economy recovers from the pandemic and the summer season approaches, more natural gas will be needed to fuel electricity generation for air conditioning and other uses. Moreover, as more liquefied natural gas, LNG, export terminals come online, more natural gas will be shipped overseas to meet the growing demand from Asia and Europe. The decreasing supply of natural gas from domestic production and imports. The U.S. natural gas production has been declining since 2020 due to low prices, reduced drilling activity, and pipeline constraints. The U.S. also relies on imports from Canada and Mexico to supplement its domestic supply, but these sources are not guaranteed and could be affected by geopolitical or technical issues. The unpredictable weather patterns and natural disasters that could disrupt the supply or demand of natural gas. For example, a colder than normal winter could increase the heating demand for natural gas, while a warmer than normal winter could reduce it. Similarly, a hurricane or an earthquake could damage the infrastructure that transports or stores natural gas, creating supply bottlenecks or shortages. These factors could create a situation where the U.S. natural gas storage level drops below the historical average or even below last year's level, creating a tight market and pushing prices higher. Therefore, it is important to keep an eye on the storage data and how it compares to the historical trends and expectations. In this video, we will explain how to interpret the storage data and what it means for natural gas prices. Natural gas prices are highly sensitive to the supply and demand balance in the market. When there is more natural gas in storage than expected, it means that the supply is higher than the demand, which lowers the price. On the other hand, when there is less natural gas in storage than expected, it means that the demand is higher than the supply, which raises the price. In the latest storage report from the U.S. Energy Information Administration, EIA, released on April 6, 2023, the natural gas inventories increased by 14 billion cubic feet, BCF, for the week ending March 31, 2023. This was higher than the market expectation of a 10 billion cubic feet increase. The total natural gas in storage now stands at 1,784 billion cubic feet, which is 17% above the 5-year average and 2% above the level at the same time last year. The high storage level indicates that there is more natural gas available than needed, which reduces the incentive for producers to drill more wells or increase production. This also reduces the risk of a supply shortage in case of a cold snap or a disruption in pipeline flows. Another factor that affects natural gas prices is the weather outlook. The weather determines how much natural gas is used for heating or cooling purposes. When the weather is colder than normal, more natural gas is consumed for heating, which increases the demand and the price. When the weather is warmer than normal, less natural gas is consumed for heating, which decreases the demand and the price. According to the latest forecast from the National Oceanic and Atmospheric Administration, NOAA, the weather for April 2023 is expected to be warmer than normal across most of the U.S., especially in the Northeast and Midwest regions, which are major consumers of natural gas. The warmer weather reduces the need for natural gas heating and lowers the demand for natural gas. The high storage level and the warmer weather outlook have put downward pressure on natural gas prices, which fell below the key $2 per million British thermal units level on Thursday, April 6, 2023. This is a significant drop from the peak of $5.64 per million British thermal units reached on February 17, 2023, when a severe winter storm hit Texas and caused widespread power outages and supply disruptions. The low natural gas prices could have negative implications for the natural gas industry, as they reduce the profitability and cash flow of producers and discourage new investments and exploration activities. The low prices could also affect the competitiveness of natural gas against other energy sources, such as coal or renewable energy. However, some analysts believe that the natural gas prices could rebound in the coming months, as the demand for natural gas increases with the economic recovery and the summer cooling season. They also expect that the supply of natural gas will decline as some producers cut back on production or shut down unprofitable wells. Moreover, they anticipate that some factors could support higher natural gas prices in the long term, such as increasing exports of liquefied natural gas, LNG, to global markets, growing use of natural gas for power generation and industrial purposes, and stricter environmental regulations that favor cleaner burning fuels.